My name is Tim Kerry, lead educator, market analyst of Markets Kenya. With me again today, we have Jeff from Chase Capital. We have Purity from Pushi FX, all our partners here at Scope Markets Kenya, great traders. And today is the beginners webinar, which the beginners webinar basically is to give you the very basic concept that you need in terms of laying a foundation for your trading journey, right? So it is at least you have the knowledge, because trading leveraged product carries risk. And what you're doing here, we are trying to share with you, will help you mitigate this risk, all right? So that you can be able to approach it in the best way possible. Without much further ado, take you straight to the basic, to the very key thing. Number one thing that you need to understand for you to start trading, of course, you have to begin, you have to trade through a broker, right? So we are retail traders. We don't have very huge capital to access the market directly, like maybe some of the big banks. And the reason why we trade through a broker, right? So it is important that you create a trading account, whether a demonstration account or a live account. But as a beginner, it's good to practice in a demonstration account. This is whereby you have virtual money, meaning it's money that you cannot be able to withdraw, but all other parameters are the same. And this will help you in terms of practicing whatever you're going to be taught, So towards the end, we will be able to show you the onboarding process. That is how you fill your details, verification, etc., until to even depositing, all right? And also, at the end of this webinar, you'll be in a position to be able to execute your very first trade. That is, if you've never maybe traded before, right? So you'll be in a position to be able to execute your very first trade. When we talk about financial markets, you understand that Forex is part of the financial market, right? So we have Forex itself, which is the largest financial market, globally. Here we are talking about more than $7.3 trillion that is traded on a daily basis. So it's really quite a huge market. Then we have the commodities, and so for Forex, this is where we are talking about the currency pairs, right? The currencies. So like the American dollar, we have the Australian dollar, we have the New Zealand dollar, we have the Japanese yen, etc., etc. Then we have commodities, whereby now here we are talking about metals like gold and silver. You can talk about agricultural commodities like cotton, right? Coffee. We have corn as well. Corn is maize, it's tradable in the financial market. Energies, we can talk about oil, which is a tradable commodity. Then we can have indices. Remember, someone in yesterday's class asked about indices. Whether Scope Markets we have indices, and yes, we have. So you can be able to trade the likes of US 30, that is the WS30, the Dow Jones. We have S&P 500, we have NAS 100, that is the NASDAQ, and among many other indices, right? Then we provide also the stocks. Can be able to trade stocks with Scope Markets. That is stocks. When you talk about stocks, you're talking about buying a portion of a company's portfolio, right? So this is shares. When you talk about stocks, in a common word that we all understand, here we are talking about shares, and you can be able to invest in shares, both the physical shares, in whole units, and also in fractional shares. And also you can be able to trade these shares in a leverage way, like we trade the stocks, the currencies and the commodities and indices, right? So the key essence here is there is a lot that you can be able to trade in the financial market, right? So the key essence is to try and specialize. You become a master of something. Remember, you cannot be a master of everything, but being a master of something at least will speed your journey to success. About stocks, that's a whole different session that we do. I think the last Wednesday of the month, we will be doing a stocks webinar whereby we will talk more about the physical, how to invest in the physical shares or the physical stocks, right? So for now, this webinar, we are going to concentrate on the Forex markets, right? And when we talk about Forex, Forex is an acronym for foreign exchange, and foreign exchange is the buying and selling of currencies. So it can either be online, it can either be physical, right? So physical is whereby you go to the bank and you exchange your Kenya shillings into dollars. Um, Also, online now, what you are going to focus more is online, whereby through the broker, you are able to access the market and you can be able to transact or to trade online, all right? So that is online Forex trading. And that is what you're going to major into because online Forex trading requires some bit of knowledge. It's not just like the physical Forex trading or foreign exchange that you walk into the bank and you do your exchange and that's it. Here, you need some bit of knowledge that will help you in terms of doing analysis, so many stuff that you need to understand for you to be at par in terms of trading, all right? So Forex trading, basically, we are talking about speculation, all right? So we speculate the changes in currency value with the intention being profit making. The word speculation, let it not fool you that it's we're just speculating out of nowhere. But speculation here, for us to be able to speculate, we do what we call the analysis. So we have the technical analysis, we have the fundamental analysis, we have the sentimental analysis. Those three types of analysis, especially the technical and the fundamental, they are very significant for you as a trader in terms of knowing how to navigate in the financial markets. And that's what we shall be emphasizing now from the intermediate session. Some of the characteristics of the Forex market, I know maybe some of you can tell them, but I have already displayed them there for you. It's a high liquid market. Remember, we are talking about more than $7.3 trillion that are traded on a daily basis. So that tells you that the market is quite highly volatile, all right? The market is quite highly volatile, or there is high liquidity. This is a 24-hour market, 5 days a week, right? So we trade from Monday to Friday. Over the weekend, the market is closed, right? Then we have what we call the leverage, which basically allows you to control larger position even with a smaller capital. Remember when I was beginning, I gave a disclaimer that leverage products, as you can see my disclaimer here, I said that trading leverage product carries risk. So Forex is a leverage. Forex pairs or currencies, they are leveraged, right? So leverage is good, but if you don't understand how to use the leverage, then it can work in your disadvantage. But we are going to have a session whereby we will talk more in detail about leverage and how it will bring, how you can be able to choose the best leverage for you. Basically, in this webinar, we will have some time to talk about the leverage. Then we have low capital, low starting capital. So you just need to have the concept, and then you can begin even with as low as $20. All right. So you can begin with as low as $20. So it doesn't require, it's not capital intense. As you practice with your $20, maybe probably $100, which you're going to talk about anyway, because it is always recommended that you begin small and grow big. So small here is relative. For someone else, $20 is the smallest amount. For someone else, $1,000 might be small because we are all able differently. So small here is relative. Then there is no central exchange. So this one basically takes place through over the counter, right? So the reason why to access the market is very easy through online brokers. All you need is internet, a gadget, either a phone or a laptop, and you're good to go, plus the knowledge, and you're good to go. All right. You don't need to walk into an office for you to trade. You can trade even under the sea if your internet can be able to catch under the sea. Low transaction cost in terms of spreads, all right, and very minimal commissions. Remember, the moment you hear a broker, you understand that broker makes money through commissions. It's not in your losses, because some of people have that ideology that a broker will make money out of your losses. No, as we are going to see, when you talk about broker, this is an intermediary. So a broker serves as an intermediary between retail traders, that is we now, and the larger interbanks forex market, right? So these are now the big bosses. So even in the normal market, in the normal the way our normal markets are set up, we know a broker earns commission, right? So if you introduce a broker comes and maybe introduces you to the buyer, you are the seller that introduces you to the buyer. Of course, you have to maybe to agree on a certain percentage of commission. But here, commissions, they are very minimal. But you're going to see that when we'll be looking at the different types of accounts that we have. So when you talk about forex trading here, it's good to think buying a currency like purchasing a share of a country's economy. Why? Because you find that when you want to look at the health of a particular economy, you look at how the currency of that economy is performing. And in the financial market, we have said, in the forex market, here we trade currencies. So when we join two currencies, at least we come with a currency pair. So the price of a currency, like I said, basically is used to reflect the market's opinion on current and future health of the economy, right? So by the way, you can be able to share your questions. If you have any questions, feel free to share the questions and we'll be able to answer all of your questions. So the main goal is for the currency to increase in value or price and sell it at a profit, right? So it's just the same way when you're transacting the normal market. So in the forex market, we buy at discount, we sell at premium. So in the normal market, we buy at wholesale. We go to the wholesalers to buy, and then now we sell at retail so that you can be able to make something at the end of the day, right? So it's just the same concept, only that for forex trading, it requires more than that. It requires you to know more than that, right? So you realize that we have many currencies that are traded, right? We have each and every economy or each and every country has its own currency. So we have so many countries globally, but the point that I want to put across is that you will not find all currencies in the listed in the financial market. The reason why is because in the financial markets, we look at the currencies from developed economies and currencies from emerging economies. So most of the currencies that you interact with, they'll be basically driven from these particular the list of most traded currencies, all right? So we have number one, that is the dollar, which is the number one globally traded currency, all right? So that is the dollar. Then we have the euro, we have the Canadian dollar, we have the Great British Pound, we have the Japanese yen, we have the New Zealand dollar, we have the Australian dollar. So these are the most traded currencies because they are currencies from developed economies. All right, they are currencies from developed economies. So what also you need to understand is the symbol. All right, you need to understand how currency structure works. So like you have seen here, these currencies are represented by symbols. So we have the symbol, then we have the name. All right, we have the symbol, then we have the name. So what you need to understand is that currency symbols always have three letters. So USD, it is three letters. CAD, that is three letters. So it is not just like that. It is not in vain that it is designed that way, but you need to understand that the first two letters will represent the name of the currency, will represent the country, right? So like when you have the USD, so the first two letters will represent the country, that is the United States, and the third, all right, the third one will represent the name of the currency of that country. When we have GBP, so GBP, the first two represent the country, that is the Great Britain, and their currency name is called the pound, all right? So that is how currencies are structured. Also, you need to understand that currencies are traded via a broker, like I said, and they are traded in pairs. So if you have one currency, there can never be transaction. That is even in the real sense. If you have only Kenya shillings, you cannot transact only with the Kenya shillings, meaning that you have maybe to exchange Kenya shillings maybe to dollar, or Kenya shillings to GBP, or Kenya shillings to Australian dollar, so that we can say that a Forex transaction has happened. And the reason why when we start diving into the market, you will see these, what you're calling the currency pairs, all right? So currency pair is when we combine two currencies. So it forms a currency pair. Like maybe now when we talk about GBP, USD, right? When you talk about GBP USD. So this is a currency pair, but GBP by itself is a currency, right? So, but when we join them two, we form a currency pair. So you need to understand that each pair is in a tug of war, making the exchange rate to fluctuate based on the strongest currency at that particular moment. And this explains why when you look at the charts, if the market is trending up, or maybe we have the market trending down, you see it moves in a zigzag manner. It doesn't move in a straight line, all right, like that, but it moves in a zigzag manner. Basically, because of this what you're calling the tug of war. So if it's maybe probably GBP USD, this means that at this particular point, GBP was stronger than USD. At this particular point, USD was stronger than GBP, all right? So that's explains the reason why it doesn't really move like in a straight line as we should, maybe we might think of, right? So this point, maybe Jeff, you can take us through the grouping of currencies and what else you need to take us through. Yeah, you can begin with the grouping of currencies and take us through that.
Okay, so hi everyone, good afternoon, and welcome to this session. So thank you, Timothy. So let me share my screen and let's see what we have. So I'll start off with grouping of currencies. So I hope everyone can see my screen and I hope I'm audible. So let's get to it. Now, currencies are usually grouped differently, and in Forex trading, currencies are categorized in groups based on their trading volume, their global significance, and market liquidity. So understanding these categories helps traders choose currency pairs suited to their trading style and market analysis. So the main groupings are, we have major currencies, we have minor currencies, and exotic currencies, okay? So let's start off with major currencies. So the major currencies, they are the most traded and widely recognized currencies in the Forex market, okay? So they represent the largest and most stable economies globally. And these currencies are highly liquid, meaning that they have high trading volumes and tight spreads, making them attractive to traders, okay? Now here we have I have a chart with a list of major currencies. So here you can see we start off with the currency. The currency we have here is the US dollar. The country code or the currency itself, it's USD. The country is the United States, and the nickname is the greenback or back. Okay. Then you have the euro. The currency code is euro, EUR. The country is Eurozone, so it comprises of 19 countries, and the nickname is fiber. Okay. Then we have the Japanese yen. The country code is the JPY. Okay, as Timothy has explained, that the code usually has 3 letters. So you have the USD, the Euro, which is a EUR. Then here you can find Japanese yen, so that is a JPY. Okay, then the country is Japan. and the nickname is the yen. Then you have the next currency is the British pound, so that is a GBP. So the currency code is GBP, and country is the United Kingdom, also known as the UK. Then the nickname is the sterling or cable. Okay. Then you have Australian dollar. The currency code is AUD. The country is Australia, and the nickname is the Aussie. Okay, it's known as Aussie. Okay, the Aussie is coming from Australian dollar, so that's why it's called Aussie. Then you have Canadian dollar. The currency code is CAD. The country is Canada, and we have the nickname is known as the loonie. Okay. Then you have the Swiss franc. Swiss franc, the currency code is CHF. The country is Switzerland, and the nickname is the Swissy, okay, or Swiss, okay. Then you have New Zealand, the New Zealand dollar. The currency code is the NZD. Then the country is New Zealand, and the nickname is the Kiwi. Now, the reason why I've also included the nicknames in this is because at times you might find either financial reports or financial articles written, or sometimes even if you listen to financial journalists, maybe sometimes either on Bloomberg or CNBC or other financial platforms, you may hear analysts or economists talking about selling the fiber or selling the cable, or maybe the loonie has gained against something else, or maybe the Aussie has dropped or something. When you hear such kind of terms, you are able to relate that these are the nicknames of certain currencies. Okay, and they're not just nicknames as in street names, they are nicknames that are used even in during financial reporting or financial journalism. Okay. So that is why I have included that, because they're also important to understand that. Okay. So then we have the characteristics of major currencies. So one, we have liquidity. So they have high trading volumes, ensure minimal slippage and trade spreads. Okay. So you have high trading volumes on the major currencies as compared to the next category of currencies that I'm about to talk about, which is the minor currencies. Then two, we have stability. So they are backed by economically and politically stable countries. If you probably heard of G10 currencies, those are the major currencies, and they're the ones that we've talked about: the euro, the pound, the dollar, the Australian dollar, New Zealand dollar, Japanese yen, Canadian dollar, and such kind of currencies. So they are very stable. They are backed by economically and politically stable current countries. Then you have impactful news. So major currencies are sensitive to economic data releases, such as GDP, which is the gross domestic product. Then you have interest rates and employment reports. So usually we have fundamental releases that affect these currencies on a day-to-day basis. So these economic data, these currencies are usually very sensitive to economic data releases, and these are just examples of some of those releases, which is the GDP, interest rates, and employment reports, among other major impactful news. Then you have popular pairs. So major currencies are paired with the USD to form popular pairs like the Euro USD, the GBP USD, the USD JPY. Now, for a currency to be a pair, it has to be two currencies that are paired together. You know, we say a pair of socks, a pair of shoes. So even currencies are put in pairs. Okay. So like if you are trying to trade the dollar, you're not going to trade the dollar alone. You're going to trade it against something. So if you're trading Euro USD, it means you're trading the euro against the dollar. If you are trading GBP USD, it means you're trading the pound against the dollar. If you are trading USD JPY, it means you're trading the dollar against the Japanese yen. So that is how these currencies are usually paired, and they are traded like that. So anytime you open any position, it means that you are, which, and again, you're going to talk about that in trading orders. It means that you're either selling the euro, buying the dollar, or buying the euro, selling the dollar, which I'm going to explain more when you're getting into trading orders. Okay. So again, in case of any question, feel free to type in your questions, and we will address them accordingly. Okay. Now, the next category, we've talked about major currencies. Now, next we're going into minor currencies. Now, minor currencies are those from relatively smaller economies that are still actively traded, but less so than the major currencies. So these currencies are not paired with the US dollar, but with other major currencies like the euro, the British pound, or the Japanese yen. So here we have a few examples. So examples of minor currencies. One, we have the Swedish krona. Then the country code is SEK, and the country is Sweden. So that is basically the Sweden's currency is known as the Swedish krona, and the country code is SEK. So if you see SEK on paired with something, maybe let's say USD SEK, you know that you're trading the dollar against the Swedish krona. Okay. Then the next one you have is the Norwegian krone. Also, the country code is NOK, and the country is in Norway. Okay. So then you have the Danish krone. Then you have the Danish krone, DKK, that is the country code. The country is in Denmark. Okay. Then you have Singapore dollar, which is SGD, and I mean the country code is SGD, and the country is in Singapore. Okay. So then you have the Hong Kong dollar, and the country code is HKD, and that is the country Hong Kong. Then you have the South African rand, country code is ZAR, and the country is South Africa. Now, one of the best examples to give with this, you'll find that some of these currencies are paired with the dollar. So you'll find maybe a pair like USD SEK or a pair like USD ZAR have traded the USD ZAR. So these currencies, these minor currencies are usually paired with a major currency. Okay. Then you have characteristics of minor currencies. Okay. One, we have moderate liquidity, lower trading volumes compared to major currencies, so leading to wider spreads. So major currencies usually have very lower spreads, and you're going to see that when you get into the trading platform. You're going to see that major currencies have quite lower spreads as compared to minor currencies. Minor currencies have quite a bit of wider spreads. Then you have the next thing is economic sensitivity. So they are highly influenced by the domestic economic conditions of their respective countries. Okay. Then you have cross pairs. They are often traded as cross-currency pairs, such as the Euro SEK or GBP NOK. So that is the British pound and the Norwegian krone, or the euro and the Swedish krona. Sometimes even the USD SEK. I've seen the USD SGD, USD ZAR. I've just mentioned about USD ZAR. Sometimes even the USD ruble, which is the Russian ruble, or the USD Turkish lira. So it is possible to trade them when they are paired to a major currency. Then you have higher volatility. So minor currencies may exhibit more significant price swings due to their lower liquidity, but they have higher volatility. Okay. Then you have exotic currencies. Oh, just what I've mentioned about the Turkish lira, and I'm seeing it here on exotic currencies. So we've discussed the major currencies. You've talked about the minor currencies, and now we are about to get into exotic currencies. So exotic currencies, they are from emerging or smaller economies. They are much less liquid than major and minor currencies, and they often have wider spreads and higher volatility. So exotic currencies are less commonly traded, but can offer unique opportunities for traders willing to take on more risk. Okay. Now, examples of exotic currencies. One, you have again, sorry, we have the Turkish lira. Okay. So you have the Turkish lira. The currency code is TRY. The country is Turkey. Then you have the Mexican peso. The currency code is MXN, and the country is Mexico. Then you have Thai baht, the Thai baht, or the currency code is THB. The country is Thailand. Then you have South Korean won. The currency code is KRW, and the country is South Korea. Then you have the Indian rupee. The currency code is INR, and the country is India. Brazilian real. The currency code is BRL, and the country is Brazil. Okay. Then you have the Russian ruble. I've also mentioned about it, which is the currency code is RUB. The country is Russia. Then you have Czech koruna. The currency code is CZK, and the country is the Czech Republic. Okay. So, characteristics of exotic currencies. So we have one is low liquidity. We have less frequently traded, leading to wider bid and ask spreads. So those are the spreads that you are discussing. Then you have economic instability. So often from countries with volatile economies or political systems. That is, then you have higher transaction costs. So due to wider spreads and lower liquidity. So then you find the transaction costs on them are higher, just slightly higher, not very high, but slightly higher. Then you have potential for high returns. So greater volatility can create opportunities for larger price movements. Okay. Now, before maybe someone asks where the Kenyan shilling lies in that, I think the Kenya shilling, maybe Timothy, what do you think? The Kenya shilling, does it lie in a minor currency or an exotic currency? Because sometimes we have seen the dollar against the Kenya shilling. What do you think?
Yeah, Kenya shillings is an exotic.
Okay. Yes. Yes, it is an exotic currency. Thank you. So we have comparison of major, minor, and exotic currencies. So we have different features. These are table. We have the features, minor currencies, major currency, minor currency, and exotic currencies. So in terms of liquidity, major currencies have high liquidity, minor currencies have moderate liquidity, exotic currencies have low liquidity. Then we have spreads. In terms of spreads, the major currencies have tight spreads, minor currencies have moderate spreads, exotic currencies have wide spreads, like wide spreads. Then in terms of volatility, major currencies have relatively low volatility, and minor currencies have moderate volatility. Exotic currencies have extreme or high volatility. Then we have the trading volume. In major currencies, you have extremely high trading volume. Minor currencies, you have medium trading volume, and in exotic currencies, you have low trading volume. Then in major currencies, the risk is lower risk. Then in minor currencies, we have moderate risk. Then in exotic currencies, you have high risk. Okay. And examples that we have covered, we have tackled the different examples. We have Euro USD, USD JPY, GBP USD. Then minor currencies, again, we have the Euro, Swedish krona, GBP, Norwegian krona, Norwegian kron. Then you have exotic currencies, USD, TRY. I was mentioning this, the USD TRY, that is the USD Turkish lira. Then you have the Euro THB, this is the Thailand baht. Okay. So when you find these on your charts on the platform, you are able to distinguish between a major currency, a minor currency, and an exotic currency. Okay. So major currencies, they are ideal for beginners due to their liquidity and stability. Minor currencies offer opportunities for moderate risk and returns. Exotic currencies, they provide high risk, high reward scenarios, but require advanced market knowledge and careful risk management. So my advice will be, as a beginner, you are starting out in this trading, you're starting out in the trading world, I will advise starting out with major currencies. Okay. Start out with major currencies. Then now, as you progress, as you keep on expanding your knowledge, you can now diversify into a bit of minor currencies, a bit of exotic currencies, and maybe different other financial asset classes as you progress in your trading journey. Okay. So we have covered that. That is in terms of grouping currencies. Then I will get to talk about the trading orders. Now,
Before you talk about the
oh,
trading orders,
okay. Mhm.
I think it's best for us to be able to understand how we reach into that platform where we're going to place the orders.
Yeah, sure.
And with us, I want Push FX Purity to take us through how to create a trading account and basically some of the key features of a trading account, that is the MT5, how we can be able to navigate through the MT5 before you show us the tricks on how to be able to place our orders. Purity, can you hear us? Can you hear me?
Yes, I can.
Good. Purity?
Yes, Jeff, kindly clear your chat so that I can share. Thank you. So, good afternoon, traders. My name is Purity, also known as FX, a Forex trader. First of all, we're going to start with how to create an account, on Scope Market. Once you've logged into your dashboard of Scope Market, this is where you're going to navigate. We have 2 points right here. We have a point where you're supposed to create your live account. And
Purity? Hi, Purity.
Yes.
Maybe you can begin us from when you go to the website. Where do you click? Maybe you can log off, and then you show us how you fill the details, and then now you sign up to that platform.
Oh, okay.
Yes, you can log out from the platform. You show us how we fill the details, and then now you show us how to reach into that particular point.
All right.
Maybe I can help you on that real quick. Just stay on your platform. Let me help you real quick there. So guys, when you go to the portal, you need to search www.scopemarkets, right? The scopemarkets.co.ke. So it will bring you to this website, www.scopemarkets.co.ke. Then you have an option to open an account. But before you open an account, you need to learn the different types of accounts that we have, right? So we have, when you click here, we see that we have 3 types of accounts, and all these are explained. I will take you through these types of accounts when I'll be talking about some of the terminologies like the pips, because you can see the wordings here like pips, etc., etc. I'll be able to take you through this part, but you're able to choose an account. Basically, silver account. This one is, it has no spreads. So I feel if I mention that now and I've not told you what spreads are, you might get confused. But basically, to open an account, you just click open, right? Open account, and then it will bring you to this face or to this particular portal here, right? You see this particular portal. Let just a minute for it to load. So you fill your first name, right? You fill your last name, your email, country of residence, your phone number, your password. Then you confirm password. Then you accept terms and condition, and then now you sign up. So after you fill that information, then you sign up. It will now take you to what Purity was trying to show us. Now Purity can proceed from there to the portal. Purity.
Hello, yes, I can hear you. Just a moment. All right, let me show my chart. Well, so back to trading account, and thanks for that, Timothy. Thanks a lot. Well, I was saying that when you're creating an account, for a trader, you need 2 accounts. First account is a demo account, which is an account for practice, and also what we call backtesting. Backtesting your strategy as you trade. The second account is the live account which you need. This account is used for real trading. This is where you will deposit your money and start trading. We also use it for emotional trading because, well, you cannot get the real emotions of trading when you're using a demo account. So if you're to create a demo account, you'll come right here. You click on the demo part of it. Then you choose demo right there. MT5 is written. Account type, you will come and choose either silver or gold. These 2 right here, they all share and scope invest. These ones are for shares, all shares for shares, and this one is for investing. So for trading, we use these 2 right here, silver or gold. Once you have chosen one of those, you'll come here and include the account label, then click create. If it is a live account again, you will click here. This is now after you have logged into your dashboard, which looks like this. You will come and fill in all the details right there. Choose the account type again. And once you've chosen that, you click, you fill in the account label and then click account, create account. As for me, well, this one for mine is for shares, so I do not need another one, another account. After that, you will come right here where we have wallet. This is for depositing. Then now right here we have platforms, which this is what I'll major on today mostly. We have platforms right here. We have MT5. Then this MT5 is for mobile phone. For those who have iPhone, we have it right here. You'll come and click it at this point. Those who are using Android, you have it right here. And then we have another one right here. So you will click the link depending on which form of, like if it is a phone you're using or if it is a laptop. For laptop, you will have it right here. So once we are done with that, real quick, we'll add to MT5 navigation. Just a minute. All right, now this is my MT5. MT5 looks like this, and some terms which have been used by both F and Timothy, you will hear me tackling right here on the platform itself. The platform looks like this. Once you open it, it looks like that. So how do you navigate through this? First of all, you will need to check where you are going to get the products Jeff was talking about, the likes of pairs, major pairs, minor pairs, and the crosses. So if you come to this level right here, you'll come to market, depth of the market, and then you have your Forex pairs right here. These are the Forex majors. You can see them right there. Let's say you want to open a chart of Euro USD. You want to open a chart of Euro USD. If you want to use that one, you can come and click that Market Watch, because Market Watch is right there. We have the groupings of all pairs under this category. All the major crosses, we have all the minors, majors, and indices, and the rest. You will find them right here. So I was talking about if you want to open a certain pair or a certain chart. For example, let's say NZD card. You will come right here, then right click, and then open chart window like that. That's how your chart will look like once you right click on it. After you're done with that, on the navigation of MT5, we have these two right here, where we have zoom in and zoom out. For zoom in, this is for maximizing, and this one is for minimizing. So you want to minimize your candlesticks so that you can see how the market is. Then from there, you can, these two are used to switch the chart from left to right, like this, the way I'm doing. Once you're done with that, you can change your colors however you want. You can have them in green, you can have them in red and green, you can have them in white, depending on whichever color you choose. So if you want to change the colors of your chart, you can come here, right click, then go straight to the properties. Under the properties, you can come where we have the scheme right here. Then you can choose color on white. Color on white is quite common, which is the green and the red. Then you'll click OK, like that. Let's say you want to remove this, we call them volumes, which are down here. You'll just right click anywhere on your chart. Then you will click on the tick volumes to have your clear chart like that. All right. So once you're done with that, we have different aspects of navigating on the MT5 on how we roll on this window. This mostly is what we use to trade. Wherever you're placing your trades, this is what you will be using. First, let me go to how we got to now getting to this chart. After you have created an account, I'd skip that part. After you've created your account, you will come right here to file, then log into trade account. You will be given the login and the password. Once you've created that account, you will come and key them right here. If it is a demo, you will have it like that. The server, under the server, you are going to choose the correct server which you've been given. It will be attached to the details given to you by the broker. If it is the live account, you have them right here. We have live 2, we have DFC demo, and then we have that other one right there. So then you will click, okay, like that. So that is how we got to have this what I'm navigating here, and your account will read right here. As you can see, mine, it's a demo too, not a live account. I've said you need 2 accounts. First, it's a live account and a demo for practice. So if you check out mine, it is reading a demo. So just a minute. So after you're done with that, you're getting a clear chart of your MT5. There are some things which you check on an MT4 to set, or when you're trading. First, let's say you want to insert an object on your chart. How do you go about that? This is how we do it. You will come to insert, then come to objects, then come down further to, let's say, for example, rectangle, and you can draw it anywhere you want, like that. If you want to remove these dots, which I have here, there are 5 of them. You can double click on it and remove them. Let's say you want to have it, to minimize it, you will click on the edges right here, and you can minimize it however you want, like that. Let's say you want to fill this object, you want it filled with a different color. You can right click and go to properties, then parameters, and then click fill, like that. If you want to change the color, you can come again to parameters again. You come to common node parameters, then you can change color. For example, we can choose any color we want, like right there, I've already chosen a green color. I have a green color right there. So you can have it however you want. If you want to delete it, you just right click on it and then click delete to remove. So for inserting of objects, this is where you come, and then you have them right there. You just navigate all the way down there. On the MT5, we have different types of charts. We have different types of charts. When I'm talking about charts, is this view, which you can see right here on my screen, where I am circling. First one, we have what we call the line chart. Line chart is just a normal line showing you how the chart is moving. Are we moving up? Are we moving down? Are we moving up again? Like right now, you can see market is moving down, right? We have, before I get to that, we have what we call bar chart, and bar chart looks like that. On the bar chart part of it, we have what we call open, close, highest point and the lowest point of that of a certain bar. We have different ones. Like I can see in my chart, I have the red ones and the green ones. The red ones implying that we are dropping, the green one implying that we are going up. Now for the open part of it, this is the open, this is the close, this is the highest point, this is the lowest point. For the green one, this is the open, close, highest point, lowest point. That is for the bar chart, but most traders do not use bar chart or line chart. We use candlestick chart. This is what most traders use to trade. And on my candlestick chart, I have these two colors again. I have the green and red. Red implying the market is going down. The green market is doing what? Is going up. Let me maximize on what I've told you. You were supposed to zoom out your chart, and let's see, dig further into the candlesticks themselves. So on my candlesticks, on the red ones, these are what we call the bearish candlesticks or the selling candlestick, this one, which is going down. Then the green one, this is what we call the bullish candlesticks or the buyer's candlesticks, the bullish candlestick that is, which is showing that they are pushing up. So that is much more about candlesticks. And if you take a look at my chart, we have two interfaces or two direction of it. We have this level right here, down here, which you can see, where I call it, we call it x-axis, and this is the y-axis. On the x-axis, this is where you have your pairs lined, what you've opened from the market watch, right? What you've opened from market watch, which is this one right here. Market watch is like our market where our products are. Let's say you're going to the market to buy tomatoes and potatoes, you're going to get them right here. So this is where you choose what you want to trade. Jeff, I think he will go further into how to place what and what, but this is where you get them from, okay? So this being the x-axis, once you open a trade, it is right here. And also we use x-axis to check what is really happening on our chart. Are we going down or are we going up? Like, for example, from this point right here to down here, by using x-axis, you can come right here and pick this one. We call it a trend line. You pick it like that to show that we are dropping. Even right here where we have this one, again, we are dropping. Let's take a look at where on our x-axis our market is going up. So this level right here, from this point to this point, by just using this x-axis right here, you can see that we are going up. And the pair we are using to monitor that is Audi USD. That is Audi USD. Let's say you want to check maybe a pair like Audi CAD, that is Australian dollar versus Canadian dollar. I've said you'll come, right click, that you will get your chart window right there. And then you will go straight to the properties. Then under the properties, you will come and change color into white, then click OK to have the clear chart like that. So looking at Australian dollar, Canadian dollar versus Canadian dollar, you can see that by using x-axis that we are going down. This one right here, from this level to this one, we were doing what? We were going up. Then let's talk about the y-axis, this one right here. This one are the levels of knowing from this point to this point, how was the distance? Like, let's say this candlestick started from here by just checking without thinking much of it. And right now, we are right here. You can see that. So by using your y-axis, you can see that this candlestick has moved from 0.89249 to this level right here. So we use this one to measure the distance from this level to this area. Or if not that, we use it again to know where the current market price is. And you can see this green line right here, which is moving up and down, showing that currently our pair, which is Audi card or Australian dollar, Canadian dollar, it's at 0.9085. So we use it to check the levels or check the distance from A to B. That is work of y-axis. Work of x-axis is to know how the market is progressing. Are we moving up or are we moving down? And another thing is to check what is really happening, and also knowing which pair we have opened on that level. So lastly, I'm going to talk about different timeframes which we use on our MT5 when we are trading. We have what we call timeframes. Timeframes, this one means that certain time on your chart when you open it. Like for example, this one right here, I've clicked M1. I've clicked it right here, meaning this is 1 minute. And what it means is that simply every candlestick you can see right here has been created within a minute. Even this one right here, which is forming, this one which is dropping right now, it will close after a minute. So all of them, it doesn't matter how big or how small they are, they take 1 minute. So we have the M's right here. M5 stands for 5 minutes, M15, that is 15 minutes, and then M30, that is 30 minutes. It so means the same, that is the duration all the candlesticks are taking to close. This one took 30 minutes, this one will take 30 minutes. After 30 minutes, which is in the next 2 minutes, this candlestick will close, meaning that it opened from 28 minutes ago, 2 minutes remaining, and then it will close. When you come to this part right here, we have hours, that is 1 hour and 4 hours. Same story of how long the candlesticks are taking to close and, are taking to open and close. Then we have daily, and then we have weekly, and then we have monthly. Now, someone would ask me, why so many different time frames in one chart? We use this one for analysis. When you will get to the next level, you'll get to know how we use different time frames to analyze different charts, and how do we get to come to a conclusion that it's one, either we're buying this pair or we are selling that other pair. Now, once you're done with all that, we have now what we call now the real trading. Now, where do you place the trade? How do you go about that? And this is where you will come, where we have new order right there. But I'm sure Jeff will explain more on the spreads and the pips and everything. So I'll not get to that. You just come simply to this, and then let's say you have analyzed the market and you've seen that this pair is truly going down. When it is going down, we sell. When it is going up, we buy. So at this point, you'll come straight to the new order, then click what? Your sell right there, like that. That is how you place an order. We use this one right here. So I don't know if there is another part which I have left on the MT4 navigation.
Maybe Purity, someone is asking what is account label? Maybe you can go back to the portal. Go back to the portal.
Okay.
Yeah, so as she goes back to the portal, someone asked, where do you class Bitcoin? Bitcoin is a cryptocurrency. So it is, cryptocurrencies in Kenya, they are not regulated. So the reason why you'll not find Bitcoin in Scope Markets Kenya, but you'll find Bitcoin in Scope Market South Africa or Scope Market UK. But in Kenya, they are yet to be fully regulated, right? So we are not allowed to offer them as tradable instruments. So at the portal, when you click account label is here, MT5, basically showing you, with some brokers, they have MT4 and MT5 platform. Those are the two platforms that you can use to execute your trades. But for us, as Scope Markets Kenya, we basically dwell so much into MT5 because MT5 is an improved version of MT4. It has more features that will help you manage your trades than the MT4, right? So account label is the type of account, whether MT4 or MT5. That's what you're calling account label, right? So I believe that one is well answered. Let me see if I have another one relatable to what. While creating a live account, I could select an account type. I couldn't. Yes, when it is set in default that when you open, it will open a gold account. So if you feel that you don't really need the gold account, maybe probably you can just do an email to account manager or to support, and you ask them to create a silver account, right? You ask them to create a silver account. The same case to the all shares account and the invest account. The all shares account and the invest account, they are both for investing in the global shares. Okay, so Brian, so you didn't miss anything at all. That's how the system is designed. Okay, so what are some candlesticks longer than others, yet time frame is the same, and what contributes to the behaving like so? So it's the volatility. The ones that you see longer, the longer candlesticks means more volatility. The small candlesticks means there was no volatility. But again, don't, next week, we are going to do an extension of this, the Forex Intermediate. Remember, this was the Forex 1.1 or the Forex Basic. So in the Forex Intermediate, we are going to delve so much into candlesticks, what they are, how to interpret these candlesticks in terms of giving you trading opportunities, etc., etc. Right? So Brian will be able to explain that more in details. So about leverage, I'm about to talk about it. So maybe a question will be answered, Musa, when I'll be talking about the leverage. So right now, maybe I'll ask Jeff to take us through how to place orders. So the market orders, the pending orders, how we place them now in the MT5. You have been shown how to navigate in the MT5. So the next key thing is now, how do you place orders? Because the real deal here is to buy and sell, right? So how do we place those buy orders, sell orders? So Jeff, you can take us through that.
Yes, thank you. So I think by now we already now understand what an order is, but maybe I'll just go through it quickly. Then now I show you step by step on how to place these orders on in the markets. So an order is consists of instructions to a broker to purchase or sell security on an investor's behalf. So an order is the fundamental unit, the fundamental trading unit of all financial markets, meaning all trading happens first when an order is placed and when it is finally executed. So you cannot say that you're trading if you do not have an order that is either active or pending in the markets. Okay. So trading usually happens through a bid and ask process that is facilitated by the broker. The bid is the buying price and the ask is the selling price. Okay. Now we have this is a form of a willing buyer, willing seller type of process. So this means that to sell, there must be a buyer willing to pay the selling price, and to buy, there must be a seller willing to sell at the buyer's price. So unless a buyer and seller come together at the same price, no transaction occurs. So when the order has been executed, the order is considered to be filled. So the bid and ask are constantly changing as each buy and sell represents an order. So as orders are filled, the levels will change. So for prices to move, all the bids and offers have been taken out for that particular price level for it to go to a new price level. Now, let me start with the components of an order. So how an order looks like and the components of each order. So when I get to the trading platform, so an order must have certain elements clearly stated before the broker can execute it correctly. One, you have the symbol. So you remember when we were discussing, when you were talking about these currency codes. So these are the symbols. The symbol, the order must clearly state that the currency pair that is being traded. So if you're trading USD, you're trading GBP USD, Euro USD, or whichever currency that you're trading, then the volume. So the order must have the lot size being traded. Then it must specify if it is either a buy or a sell and the type of order that it is. Okay, so let's get into the platform and see what you have in terms of that. So we have that. Now, when you are executing an order has, we've just said that an order has 4 components. Okay, so when you click on new order, okay, it brings you this. So this is the symbol. This is the first component. This is the symbol. So the symbol, you can see it's the currency pair, USD CHF, or any pair that you are actively trading. Then you can see the type here. You have market execution. Then here you can see the volume. So this is the lot size. We usually take trades in terms of lot size. We position our trades in terms of lot sizes. Then we have the action. If you are buying or you are selling. Okay, you are either a buyer or a seller in the market. Those are the only 2 actions that you can do. You can only buy or sell in the market. Okay. Now I will focus on the types of orders that we have in the market. Now we have market execution. When you see these are a market execution order, okay, a market execution order is one that means that it's executed at the current market price. Okay, so a market order, okay, a market order is one that is executed at the current market price. Now, for example, what you have here, you can see this is the volume and market execution. Here it shows it's market execution, right? So if I click this cell, it is immediately fed. It immediately goes into the market. Okay, you can see here I've placed an order. However, if we do something like we click on new order, then we change here from market execution now into a pending order. You can see now the dynamics change. The instructions change. Even the interface here changes. You can see when it is market execution, just volume, stop loss, take profit, and sell or buy. But when you now click this drop down here, you can see you have market execution and a pending order. Okay. Now here at pending order, we have different types of pending orders. When you click at this type, you can see here you have a buy limit, sell limit, buy stop, sell stop, buy stop limit, and sell stop limit. Now I will focus on these 4: the buy limit, sell limit, buy stop, and sell stop. These are the most important orders to learn and how to place them and execute them in the market. Okay. So first, I'll start with buy limit, with the buy limit order. This one here that you can see on my screen. Okay. Or maybe before even starting with that, I should explain what a pending order is. So a pending order is an instruction given to a broker to execute a trade at a specific level, at a specific price level in the future, rather than at the current market price. You've seen the one that we had on market execution. Anytime you just click on it and you sell or buy, it's executed at the current market price immediately. But a pending order is it's meant to be executed or to be it's meant to be executed at a later time or in the future. Okay, it's not something that will be executed at current market price. Okay, So usually, traders use pending orders when they anticipate that the price will reach a certain level and want the trade to be triggered automatically without needing to monitor the market continuously. Okay, so if, for example, you don't want to find yourself monitoring the markets regularly or every other time, you can now use the pending orders. Okay, so pending orders, you can use them to execute trades at specific price levels in the future. So we have different types of pending orders. Just a minute. You have different types of pending orders. Maybe let me share this. I'll toggle between what I have on the. I'll toggle between the platform and the notes as well, so that you're able to relate what I am discussing and what I'll be elaborating on the charts. So we have different types of pending orders. So the platforms such as MT4 and MT5, they offer 4 main types of pending orders. One is the buy limit order, and it's what I wanted to start with. So a buy limit order is placed below the current market price, instructing the broker to execute a buy trade if the price falls to the specified level. Okay. So let's see how a buy limit order is done. So I've said it's placed below the current market price, instructing the broker to execute a buy trade if the price falls to the if the price falls to the specified level. So, for example, if we look at that, what you have on the charts, and we have this is on USD CHF. Yes, this is on USD CHF. Maybe let's take a different pair. Like now, this is USD JPY. Okay, this is the dollar against the Japanese yen. So if I anticipate that price is going to, yeah, so if I anticipate that price is going to get to this area here, 158.316, and it keeps going higher, what I'll do, I'll come new order, change it to a pending order. Then you have a buy limit. We use the buy limit. So the buy limit is the one that you place. It should be below market price. Okay, and that is why you anticipate that price will drop, then price will drop, activate that order, then reverse and keep going higher. Okay, so in this case you have this buy limit here. Now I will use a volume of this as 0.03. Then price, I'll put it at 158.316. Then the stop loss is meant to limit your losses. So anytime you've deposited your funds into an account, you're not trading with the whole amount. You're trading with a fraction of that amount. So when you use a stop loss prevents you from blowing the whole account. So for example, now on this one, your stop loss, let's say we use 158.120. 158 158.120. Then the take profit is 159. So the take profit will definitely be higher than will be higher than the price. Now you can see even what the information it gives you here. This is the order number, then your buy limit, USD JPY at this price, your stop loss and your take profit then tells you done. So that is how you confirm that your order has been executed in the market. Now, do you see the difference between this order here? This one says sell, and this one is a buy limit. Okay, so here we are expecting that when price comes to this area, it will activate there. Like now, what you're seeing here, it has tapped the buy limit. You can see now it has been activated. Previously, it was a buy. Now it was a buy limit. Now it is a buy because it has been activated. Okay. Then we have, you can see this one. This one is a sell. Okay. The previous one was a buy limit. Now, when it has been activated, it has become a buy. Okay. Now that is a buy limit. So you place it below market price, where you anticipate that price will drop, then tap that level and then reverse. Okay. Then the next one that we are going to cover is a sell limit order. Okay. Now, a sell limit order is placed above the current market price. Okay. A sell limit order is placed above the current market price, instructing the broker to execute a sell trade if the price rises to the specified level. Okay. So a sell limit is placed above current market price, instructing the broker to execute a sell trade if the price rises to the specified level. Now, for example, again, if you go back to the platform, okay. Now let me use an example of let's use an example of this one here. Okay. Now this is the USD CAD, the dollar against the Canadian dollar. So for example, now current price is at 1.43849. If I expect that price will get to this area, then drop. Okay. If I expect that price will come to this area, then drop, I will place a sell limit. So you'll come here, new order, pending order, then sell limit. Then you put the price. The price should be above the current market price. So here we have 1.44314. Then your stop loss will be above your price. So we'll use 1.44500. So in this case, let's use stop loss 1.44500, 1.44500. Then the take profit will be below. So for this one, maybe let's use a take profit of 1. Let's use this one. So let's say 1.43200. 1.43200, like that. Then place. It tells you the order number, then sell limit USD CAD at the price, then you have a stop loss, take profit, then done. So when price, you can see here it is a sell limit. Here, this one was a sell. This is a market execution order. This one is a pending order. Where is it? Yes, this one is a pending order. So we expect that price will come to this area. We'll see price rise to this area. Then if price taps this and drops, then our order will be activated. We'll see our sell limit order being activated. Then you'll see a drop in price. Okay. So you can see it is above current market price. Current market price is here, so it is above the market price. Okay. Then you have a buy stop order. Okay. Now a buy stop order. Now, a buy stop order is placed above the current market price, instructing the broker to execute a buy trade if the price rises to the specified level. Okay, so traders usually use buy stop orders when they expect price to break above a resistance level or to keep going higher. Okay. Then you have a sell stop order. I'll use the explanation, then I'll do the explanation to explain both of them on the charts. So then you have a sell stop order. So a sell stop order is placed below the current market price, instructing the broker to execute a sell trade if the price falls to the specified level. So traders use sell stop orders when they expect the price to break below a support level and continue moving downwards. Now, if you go to the charts, I will explain both the buy stop order and the sell stop order. Now, back to these charts. Now, you see, for example, what you have here. Okay, we have put a sell limit at this area. If you expect price to keep going higher till this area, you can have a buy stop order till here. I usually love equating these to, maybe if you equate it into a real life scenario. If you're using public means, if you're using public transport and you are at a bus stop, okay? If you're at a bus stop and a bus or a mart comes and picks you from there, it does not shift, it does not change its direction. It keeps going in the direction that it was going. It just picks you, then keeps going. Now, use that same analogy into this, okay? So if the market is going to keep going higher, now that is for stop orders, not for the limit orders. The limit orders, you are expecting reversals. For stop orders, you're expecting a continuation of the trend. So in this kind of scenario, if you're expecting price to keep going higher till this area, you can have a stop order at, now in this case, maybe let's do a stop order at a buy stop order at 1.44100. So I'll come, new order, then pending order, buy stop. Okay, we've covered the buy limit and sell limit. Now this is a buy stop. Then it will be above the current price. So 1.44030. Then if we are to do this is 1.44030, then let's see, stop loss below that is about 1.40, wait, 1.43800. So maybe let's use that. 1.43800, and then now you can have a take profit at 1.44 400. This is just an example to 1.44 400 in this case. Okay, then if we do that, see what you have here. Now the buy stop is above here. These are current price. Okay, so we expect that if price is going to get till here, when price goes all the way, when it gets here, it will activate this buy stop, then keep going higher. Okay, remember the analogy I've talked about when you're using public transport and the bus comes and picks you at a stage or a stopover. It does not change its route. It keeps going in the direction that it was going to. It only that it has stopped to pick you. So it's the same kind of a scenario. So when price comes to, if price is going higher, it will come, activate your order and keep going higher. Okay. So we have that on buy, that is a buy stop, and then the reverse is true now for a sell stop. Maybe let me look for something that for a pair that is going down. Let's see what you have. Let's see what you have. This is USD CAD. Okay. Maybe let me use USD CHF because it's the one that you had clicked a sell on. Now, that is a sell on USD CHF. Now, if I anticipate the same thing, that price is going to keep going lower, you can have a sell stop maybe at, let's use, for example, this one is 0.91,000. So you can new order, pending order, then sell stop. Then we have 0.91,000. Let's do 0.91,000. 91,000. Okay. Then you have a stop loss. Maybe the stop loss can be 0.91300. That will be about 30 pips, 0.91 300. Then take profit 0.90 400 below. 0.90 400. Now you can see the sell stop is coming below the current price, and the one that you had as a buy stop, the buy stop was coming above current price. Okay, these are buy stop, these are sell stop. Where is it? USD, this one, yeah. So these are sell stop. So if we are expecting that price is going to keep going lower, it will come, activate this, and keep dropping all the way to now our target area, which is this one here. Okay. So we've covered the trading orders. market execution, that is an instant execution. On some platforms, maybe if you are using a different, if you're using the default, if you downloaded like the MT5, it will tell you a different either instant execution or market execution. So anytime you find something like that, just know that's a market execution order that will be executed at current price. But pending order is meant to be executed at a later price, at a later time. And you have 4 types of them. You have a buy limit, you have a sell limit, you have a buy stop, and we have sell stop. Now, something again I'll just mention about is stop loss and take profit, because they're part of these orders. So, but then again, as we talk about pips and all that, Timothy will elaborate more when we get to talk about pips and lots and how to calculate that. So when you have any trade that you take must have these 2 components. Any trade that you're taking must have these 2 components. It must have a stop loss, it must have a take profit. Okay. And the reason is because a stop loss, do you see, like, for example, you have this one here. This is an sorry, this is an order that is open. A stop loss here in case price goes against me. Okay. In case price goes against my intended direction, it goes against me, this stop loss is what will protect my account. So the stop loss is there to protect your account, and it is also there to minimize your losses in terms of when you take a certain risk, the stop loss, that stop loss is the risk that you're comfortable taking. The amount of money that you're comfortable losing. So in case the trade goes against you, that is your stop loss will be triggered, and it will take out your position with a comfortable loss. Okay, with a loss that you are comfortable with. Again, with a take profit is more of a target. So when price gets to, maybe you've like now in this example, if price has dropped all the way till this area, you can see here you have a TP, this is a target. So if price comes all the way till this area, it will close out now my positions in profit. Okay. Again, it will close them out in profit, because each trade you take must have a target, because the price will not just keep going up or down the whole time. Sometimes you'll not find price that are going all the way up or maybe all the way down. Sometimes you'll find these kind of pullbacks, these kind of retracements that happen in the market. And when such kind of pullbacks and retracements happen, you will have to take out some profits. Okay, so that is the work of the take profit. So the take profit and the stop loss are things that you adjust anytime you are taking your positions. Now, maybe someone may ask if the stop loss and take profit can be used on market in both market execution orders and pending orders. Yes, it is a must on both pending orders. I mean, on both pending orders and market execution orders. Okay. So with that, I think I can see a question from Stephanie Odundo. Can exotic currencies be traded against each other, or minor currencies against exotic currencies as a pair? So usually, for exotic currencies, they can be traded against each other, and minor currencies also can be traded against each other. So usually, from what we've talked about, we have major currencies, minor currencies, exotic currencies. So how they are paired is how they are traded. So for example, maybe let's do this market watch here. You can see this, like now here, this Euro USD, the Euro is paired to the dollar. These are major currency. But now maybe let me get a minor one, like let me do a, yes, you have, this is Euro GBP. This is the Euro and this is Euro CHF. Now these are perfect. This is Euro CHF, the Euro against the Swiss franc. Okay. So you can be able to, they're usually already paired. So it's not like you are trying to select and then pair them so that you can trade them yourself. They're usually already paired for you. So it's just a matter of selecting and executing. So yes, you can, exotic currencies can be traded against each other, or minor currencies against, I mean, minor currencies against each other. You'll find maybe you're trading a pair like CHF JPY or this is like now this is a Euro CHF, okay, and other different pairs. So yes, they can be traded against each other. Then I can see Ali Hassan Musa. What is leverage? Okay. Then I can see Evelyn come. Hi Jeff. Oh, hi Evelyn. Kindly advise me on the long weeks. When I place a stop loss, they take me out of the market sometimes. Okay. This one let me handle. So for Evelyn, now with Wix, I think now this is more advanced. I wish you had asked me this during live analysis sessions, because these are more of an advanced question, but I'll just answer it. So with Wix, anytime you are placing your stop loss, anytime you're placing a stop loss, at least make sure that your stop is about 25 to 30 pips above or below your resistance or support area, so that you avoid getting stopped out. So usually if you're getting stopped out because of the wicks, it's because your stops are too tight. So if you're placing a stop of about 15 to 20 pips, then that is too tight. So anytime you're taking a trade, have your stops at least 25 to 30 pips to give you a trade more room, more breathing room, and also to allow these kind of fluctuations to happen before price eventually goes into your direction. Okay. So again, for now, the guys in this call, we usually have live analysis sessions. We usually have market live analysis sessions every morning on Mondays to Thursday, every 10 to 11 a.m. So like now the question I've just answered is from someone who we do this session, who is a member of those sessions. So as we progress, we'd also like you guys to join into those sessions. They are very informative, very educative, and you will be able now to understand what you're talking about much better. You'll be able to see us execute these orders. You'll be able to see us now do the actual analysis of these currency pairs. So thank you guys, and back to you, Timothy. Thank you.
Thank you, Bishop Geoffrey. Maybe you can allow me to share. Yeah. I was saying Geoffrey can make a very good pastor or a very good bishop. You know what I'm talking about. But again, thanks for the good job. So in Forex trading, we have different terminologies that you'll always come across. For instance, you know, each and every industry has its own terminologies or its own jargons. So in Forex, we talk about different types of terminology that will come across. For instance, when we talk about going long, this means buying. When we talk about going short, it means selling. So if I say I'm going short GBP USD, it means I'm selling GBP USD. If I say I'm going long Euro USD, it means that I am buying Euro USD. So then he has explained about the aspect of the quote, and the quote comes into place now when we effect the price, all right? When we have the aspect of the price. Remember, I talked about a currency pair. This is where you pair two currencies. So when you introduce the aspect of the price, now it becomes a currency quote, right? And we have two prices, the bid and the ask price. So the ask price is the buy price. The bid price is the selling price. So if you want to buy, you click the ask price. If you want to sell, you click the bid price, because there are some others you'll find written, instead of us writing buy or sell, they'll have ask or bid, right? So it's good for you to understand that. Then we talked about the spread. Now, the spread is usually the difference now between the bid and the ask price, right? Because there is the price that you're buying with, and there is a different price that maybe probably you are selling with. So the difference between the buy price and the selling price is what we call the spreads, all right? So having said that, what else you need to understand is that we have talked about, or we have defined what is a currency pair. So you need to understand what we call the PIP. You also need to understand the leverage. Someone asked about the leverage. And also you need to understand the lot size, all right? Those are very critical concepts that you'll need to know so that now you can be in a position to be able to execute those trades with logic, right? So I will explain those ones in a few slides ahead, but here I want you to realize that there is something that we call the margin call. So a margin call, this is an order that you, or a notification that you receive when you are trading equity goes below the expectations. That is when it goes below, when it reaches 150%, the margin level percent 150, you receive a margin call. And a margin call, basically, it's an SMS or an email, an SMS and an email that is notifying you that your equity has reduced significantly and you need to deposit some funds so that you can be able to trades. So there are two ways you can be able to approach this. So you either close some trades. If you don't have funds to deposit, you can close some trades. Or maybe you can top up some funds if you are sure with your analysis that maybe probably the price is likely to retrace and go in your direction, right? So if you don't do that, then the system will close you automatically once you reach the stop out level, which is 25%, margin level of 25%, that is the stop out level. The trades will start closing you one by one, beginning with the trades with the highest loss. This is done so that you can be able to protect you from negative balance, because we don't want your account to go negative 100 balance. So which means that when you're depositing, you'll have to deposit more than $100 for you to have some funds to trade. So we do that basically to protect you from the negative balance, right? So then when you talk about the PIP, PIP is actually an acronym of percentage in profits, right? It's an acronym of percentage in profits. So allow me to, I wanted to use a blackboard, but I can still use here for showing you how it's done. So I wanted to use a whiteboard, but I can still illustrate here. So when you're talking about pips, this is the measurement. It's a unit of measurement in the financial market, in the Forex market, all right? So if this market moved from point A to point B, we will say that the market moved X number of pips, maybe 10 pips, 20 pips, 30 pips, 40 pips, or whichever the number of pips. So this is a unit of measurement. Just like in real sense, we measure maybe distance from maybe Kisumu to Mombasa in terms of kilometers. So in the market, we measure in terms of pips, right? So pips is an acronym of percentage in points, right? Percentage in points. That is the acronym for, that is which brings us to the acronym of pips. So there are two types of pairs, currency pairs. We have currency pairs with 5 decimal places, and we have currency pairs with 3 decimal places, right? So all these have a different way of calculating the PIP value. So how do you go about it? So we'll begin with currency pairs with 5 decimal places, like the GBP USD, Euro USD, all right? And maybe let's, for instance, take a pair like GBP USD. I'll call it GU, basically G to represent GBP and U to represent the dollar. And we take maybe this price given here, price of 1.24, right? 24683. Remember here, when you're calculating pips, is basically addition and subtraction, very simple mathematics. And again, you're calculating your money. Even for someone who has never gone to school in the real world, not say that you have never gone to school, for someone who have never gone to school in the real world, if you give them 1 million shilling, they'll be able to count that money and tell you this is 1 million shillings. Unajua mahali kuna pesa, unakuwa chap chap. So here we are talking about addition or subtraction. So there is no finding X, there is no finding Y, or those stuff, right? Very simple. So let's take the first scenario, a sell scenario, right? A sell example. So, and we want to sell GBP USD for 20 pips. So we begin counting pips from the 4th decimal place. This is where we begin counting pips. So the third decimal place is what we call a fraction of a pip. All right, this is what is called a fraction of a pip. So 10, or basically we call it points. So 10 points equates to 1 pip. So if this increases from 3 to 4, 5, 6, 7, 8, 9, 10, we add 1 pip. So this is what is illustrated here. So if we want to do maybe sell for 20 pips, then we begin arranging from the fourth decimal place, going to the left, all right? So remember we are selling, and Jeff has shown you when you are selling, we are expecting the price to drop. So what it means is that we are going to subtract 20 pips from this so that we can be able to get what? Our target profit, or our TP, or our take profit, the one Jeff talked about. So we will have 8 minus 0, 6 minus 2, that is 4. Then these other ones are constant. That is 4, 2. Our point is there, right? And then we have 1. So these 3 is constant. Remember, 1,000 bob without a shilling is not 1,000 bob, it's 999. So these 3 here is constant for it to be whole 20 pips, right? It has to be constant there for it to be a whole 20 pips. So that is the selling scenario. Let's look at the other scenario, the buy scenario. So when you're talking about a buy, we are anticipating the price to push higher. All right, we are anticipating the price to push higher. So if this is now a buy scenario, so let's say for instance we are buying this for 150 pips from the same price. So we begin from the fourth decimal place. We arrange as we go to the left. You remember the mathematics you did in primary school, ones, tens, thousands, hundreds. You remember those mathematics? So we arrange going to the left. So when we are buying, we are expecting the price to go higher. So now we will be able to add 150 pips from our buying price for us to be able to get what? Our take profit. So we'll have 8, 6 plus 5, that is 11, carry 1, 5, 6. Then we have 2, then 1 point. So we said these 3 is constant. So that will be our take profit if we are buying GBP from this price for 100 pips. Don't worry about if you don't, maybe you might not grasp this for this time. This webinar is being recorded. You can just ask for it, rewatch, and take notes, right? And maybe probably you'll be able to understand. So the other category is when we have 3 decimal places. So currencies with 3 decimal places, these are currencies that are paired with the JPYs, right? So any currency that is paired with the JPY, Japanese yen, it has 3 decimal places. So it's just the same stuff. So for instance, we have USD, JPY. So at this given price, they are 108.517. So here we begin counting pips from the second decimal place. So the third decimal place is a fraction of a pip, or what we call the points. Okay. So if, for instance, we begin with a sell scenario, selling maybe this one for, let's say, maybe 50 pips. So we have 0. We begin arranging from the second decimal place. Then we have 5. So because we are selling, we are going to subtract, because selling, we say that the prices are going lower. So we have 5, 1, 0, then 0.801, and this 7 is constant. So this will be our take profit if we are selling, all right? Let's say maybe from this price, we buy, maybe let's say for 1,000 pips. From this price here, we buy for 1,000 pips. So we have 0, 0. Remember, we begin from the second decimal place as we go to the left. 0, then 1. All right, so this is a buy scenario. So we anticipate the price to go higher. So we are going to do what? To add 1,000 pips. So we will have 0.811, and this 7 is constant. So this will be our take profit when we are buying USD JPY for 1,000 pips. So you can see it's simple mathematics, all right? It's simple mathematics. So for you to get the video, you have to sign up first of all, so that you can be able to access the video. So make sure that you sign up. Don't just send an email make sure that you sign up so that you can be able to get the video with ease. All right. So, so what do we have here? So then the next thing is the lot size. So the lot size, this is the position size or the volume. So we have three types or three categories of the volume or the lot size that we talk about. So we have the mini, we have the micro, the mini, and the standard lot. So micro lot is from 0.01 to 0.09. So that tells you the smallest position or the smallest lot size you can have is 0.01. So anything from 0.10 to 0.99, it's a mini lot, and a standard lot is 1.0 and above. So the lot size now, when we combine the lot size with the pips, I'm trying to rush up because our bishop has taken a lot of time here. So the reason why I'm trying to brush to really move through, but I also want to make sure that you understand because we need to wind at around 5. So when you combine now the pips and the lot, this is how we put it. This is like the basic formula, all right? So you know you cannot change a formula. So we say that for every one standard lot that you use, for every plus or minus 10 pips movement, all right? 10 pips movement, you will make or lose $100. So what does this mean? That if I open a position with 1.0 volume or 1.0 lot size, if the trade goes in my direction plus 10 pips, I'll make a profit dollars for every plus 10 pips. But if I buy and the market sells, it means that for every negative 10 pips, I'll be making a loss of $100. So that tells you now here you can do cross multiplication, 10 plus or minus 10 pips being constant. So if probably you use a mini lot of 0.1, right? Plus or minus 10 pips is constant. So that tells you you will make or lose $10. All right. If you use 0.01 plus or minus 10 pips being constant, you are going to do what? To make or lose $1. So this brings us now to the aspect of risk management, because I know you are going to ask me which is the best lot size that I need to use. So we always say that do not risk more than 1 to 2% of your account. So let's take an example of an account of $500. So let's say maybe you are taking the highest risk, 2%. 2% of this is $10, right? That is $10. So that tells you you can never use one standard lot size because this is very high risk. You can see only 10 pips you are losing. In case the trade goes against you, you're just losing $100. And here, according to the rule of thumb, that we need to risk 2% at most. So 2% of our capital here is $10. So if I'm going to use a mini lot size of 0.1, then it means I need to have a stop loss of 10 pips, right? I need to have a 10 pips SL. If I'm going to use maybe probably a 0.05 lot size, then it means that I need to have what? 20 pips SL, stop loss. That is what I'm calling SL. So what aspect is being driven here is that the higher the lot size, the higher the risk. So if your risk level, if you do your analysis, which you're going to start showing you how to do analysis in the intermediate session, I'll share the link for the intermediate session at the end. This tells you that if you have a big risk level, for instance, let's say maybe we do our analysis and we realize that we have 50 pips stop loss. So what does this mean? 50 pips stop loss means that now if the stop loss level is big, then it means that we need to reduce the lot size, all right? So meaning that here we are going to use 0.02, okay? We are going to use 0.02. So the bigger the risk level, the smaller the lot size, all right? So that is when you're doing proper risk management, okay? So that is about lot sizing. So lot sizing. So before I go to the leverage, I can see a question here. Can the value of BIP be the same if Euro USD gets 100 pips in the value, same when USD JPY? No, sometimes it's different, right? It's different, but that's very deep mathematics that I might maybe probably start scaring people here to see like if Forex is very complicated, but this is the basic, especially for measures like Euro USD, GBP, USD. So this is the basic AUD, USD, NZD, USD, all right? But for USD JPY, you might find it's slightly different, okay? So it might take a whole hour, maybe trying to explain, almost like 30 minutes trying to explain for the USD or other currencies. But to make your work easier, Harrison, we usually, maybe I can share more insights in our live analysis session. I don't know whether you attend that, but I'll also share the link for tomorrow's live market analysis. I'll also try to share some more insights in the Telegram group, in our Telegram group, so that you can be able to read by yourself and understand that difference, okay? So then we move on to the lot size, right? I mean to the leverage. So when you talk about leverage, leverage is a double-edged sword. It cuts on both sides. The higher the leverage, the higher the risk or the higher the rewards, all right? So you can hear the higher the risk or the higher the rewards. So we have different types of leverages, and by definition, leverage is the credit facility offered by a broker to enable traders to trade with higher volumes than their capital. So it's not like credit your bank. It's not like the bank credit, all right? So you'll not see it in your MetaTrader 5, in your balance or something, but it is automated. It is automatic. So for instance, we can have different leverages, 1:1, 1:30, 1:50. But since Stock Markets Kenya is regulated by CMA, the maximum leverage that CMA allows us to use or to give to our clients is 1:400. So what does leverage help you, or what is the significance of leverage? So if I'm using a leverage of 1:30, for instance, it means that for every dollar I deposit, it is magnified or it is multiplied times 30. So it increases the margin, all right? It increases the margin. I have done a very simple table here, a constant deposit of $1,000 account with different leverages. So you can see the available margin. So the higher the leverage, the higher the available margin, meaning that the higher the available margin, the more a bigger lot size you can be able to use. Let's say, for instance, this one might use maybe 0.1 maximum lot size. This can use 0.5. I'm just giving it as an example. This can use maybe 1 lot size. This other one can use maybe probably 1.5. This can use maybe probably 2. Just giving an example. Don't take this as the actuals, right? Remember, when you want to get the actual lot size, you have to look at the percentage that you want to risk, maybe the maximum 2%, and then now you look at your risk level so that you can be able to come down to the best lot size, all right? So the higher the leverage, the higher the lot size, because you have more available margin, okay? So now summing it up all together, combining the concept of the pips, the lot size, and the leverage. I do this in a very simple table for you to understand trader 1, trader 2. Remember, capital is the same, $600, $600. But now we start differing with the leverage. The first trader using a leverage of 1:100. The second trader using a leverage of 1:400. So we have said if you use a lot, so for this first trader, you can use a maximum lot size of maybe 0.1 because he has a smaller leverage. This can use maybe 1.0 because he has a bigger leverage. So we have said for every plus or minus 10 pips, when you're using a 0.1, you'll either make or lose $10 for every 10 pips. Here, the trader 2 using 1.0 lot size or a standard lot size, he will lose or make $100 for every 10 pips movement. So the risk level, you can see now, trader 1 is within the best recommended risk Don't risk more than 1 to 2%. Actually, between 1 to 2%. So don't go beyond 2%. So to get the risk level, you take the amount that you are risking, that is $10. You divide by the capital, then you multiply by 100, and you'll get 1.666666 recurring, which is rounded off to 1.7. So this other one is going to, if you take $100 divided by 60 times 100, you find that the risk is 16%, 16.7%, quite high. Meaning that if this trader is taking 10 pips stop loss trades, you only need 6 trades and the account is blown. 6 trades that goes in the negative direction, or losing trades, and the account is no more, which is possible. But you can imagine for trader one, he will need like 60 trades consecutive losses, which is not really possible, especially if you have undergone through this curriculum. And even if you have not undergone through the curriculum, I tell you, it is impossible for you to have 60 consecutive losses. 60 consecutive losses, that's a lot, right? So that is the essence of the pips and lot size and the leverage. So I believe, Musa, your question is well answered. Then I want to culminate by looking at the trading sessions. So we have different trading sessions. We have 4 trading sessions: the Sydney, the Tokyo, the London, and the New York. So most of the times you'll hear traders talking about the Asian session, the London session, and the New York session. So what you need to understand is that the Sydney session and the Tokyo session, they can be combined together to form, the Sydney session and the Tokyo session can be combined together to come up, or we call it Asian session. Why? Because if you look at this timing, you see Sydney and Tokyo, they are the sessions that are overlapping most of the time, right? You can see the overlap is about 7 hours here. So Sydney will only be by its own for 2 hours. Tokyo will be only by its own for around 2 hours. So most of the time they overlap. The reason why you can merge it to be just one session. Another reason is because Sydney and Tokyo, they are found in the Asian continent. So the reason why we can now call it the Asian session. Then now we have the London session and the New York session. So the time given here is in GMT. You know, in Kenya, we are in GMT +3, or you need to look for your time zone depending on where we are. So if you're in Kenya, here, you need to add the time that you see here, you need to add 3 hours for you to get it in the Kenyan time. All right. So, but that again should not worry you. If you go to Google and you type trading time in Kenyan zone, you'll be able to see that information, right? So, but you can also use this one to convert and write it down somewhere so that you can be able to remember. So if these trading sessions, again, the key essence is that they will guide you in terms of choosing what to trade. For instance, if you're trading the Asian session where we have the Sydney and the Tokyo, so that tells you that you will trade pairs that are active in that session. So the likes, you know, Sydney is the capital city of Australia. Tokyo is the capital city of Japan. So here you can trade maybe pairs that are paired with AUDs, that is the Australian dollars, the New Zealand dollar, because it's just neighboring Australia. You can trade currencies that are paired with JPY, that is the Japanese yen, right? So maybe GBP, JPY, GBP, AUD, they are very much active in this session. But in this session, you cannot just come here and trade Euro USD, because Euro is not active in this session, neither is USD active in this session, right? When you come to the London session, now here you can be able to trade. You can be able to trade the GBPs, the CHF, right, and also the euros. So currencies that are traded with are paired with euro, like maybe Euro GBP, Euro AUD. So or GBP JPY, it's still active in the London session. And then we have the New York session, whereby now we have the king. There is the dollar. You know, New York is the capital city of US. So here you can trade pairs that are paired with the dollar. We said that those pairs are called the major currency pairs. And also you can trade the Canadian dollars, because it's just a neighbor of Canada, is just a neighbor of America. So it is also, CAD is also active in the New York session. Another essence, when you want to look for trading entries, though we are going to go into deeper details on this, you want to look for trading entries when you have these overlaps. That is where we have bigger or much volatilities during the overlap. So when we have this overlap, maybe the Sydney and Tokyo overlap, when we have maybe the Tokyo and London overlap, when we have the London and New York overlap, you can be able to get very nice entries. But we are going to build on that concept. Come next class, which you are going to do next week, that is Forex Intermediate. And I have shared the link right away for that session. So you can begin registering now, right? You can begin registering now. Remember, for signups, you have to sign up. You create that demo account and you practice placing those orders, because it is practice that makes perfect, right? It is practice that makes perfect. And also, we have some bonuses as well, welcoming bonus. So if you probably register, or maybe if there are some of us here who are already trading, you can register deposit. That is, you deposit a minimum of $50, and then you'll get the 100% bonus. And also, you'll be able to get, if you deposit a minimum of $100, we give you a 200% bonus. So the bonuses will help to improve or to increase your margins, right? Your available margins. So also, another maybe New Year gift that I can gift you is that if you sign up today and deposit just a minimum of $20, right? That is for new traders. You deposit today and you sign up today. You deposit a minimum of $10. Basically, I mean a minimum of $20. I'll be able to give you a one-on-one session, which I'll call it a clarity session, basically to help you streamline your view in terms of forex trading, right? So you can take advantage of that. The first, you can see we are about 30 of us, so the first 10. So make sure if you do that, make sure to send me that screenshot, 0725 70 20 79, right? 0725 70 20 79. So I will take the screenshots on the first basis, first come basis, right? Assuming that you signed up the first one. So you can share that via my WhatsApp. This is for WhatsApp only, WhatsApp number. Also, once you sign up, you'll be assigned an account manager who will be able to guide you, right, in terms of how to navigate in the markets. So remember, we said this is the platform to sign up. I believe you can be able to see it. So you just fill your details there, right? You just fill your details there. Then, like Purity showed you, you sign up and you'll go direct to the portal. So you create the live account like Purity showed you, and then now you can deposit. You can deposit and not trade, right? You can deposit and wait until you are done with the concept to trade. So depositing early will make you get the bonus, because the bonus will end in 31st January. And also it will give you the advantage of having a one-on-one with me if you desire to have really a one-on-one with me, which I call a clarity call, right? So that being said, like Jeff insisted, we have our daily market analysis, right? We usually have our daily market analysis. I'm trying to look for the link for the live market analysis. Well, let me see whether I'll get that link for the live market analysis. And also, as I look for the link for the live market analysis, we always have a Telegram. We run a Telegram, me, Jeff, and Pushi, whereby we help you in terms of trying to navigate the markets, or in terms of analysis, or what I call trade setups. So I shared the link to join the Telegram. You can click that link and join the Telegram for detailed, maybe for more assistance, right? As you get to used in the financial markets. So the link for the live market analysis is there. I've shared to everyone. So why attend these sessions is because everything that we teach, we apply it during these sessions, because here we analyze the market. It happens every day, Monday to Thursday. 10 a.m. to 11 a.m. And we usually look at the probable trading setups that you can be able to get in the market. So we got you covered in whichever perspective, and feel free to reach out in case you have you need help. In our websites, we have also we have different ways you can be able to reach us out. We have the chat option, we have the support email, and the telephone numbers that you can call for you to be assisted, right? It's not only the number that I shared, that is just my number to take the screenshot. But if you have a very technical issue, the best way to get help is through the support. They are there to help you, and also your account manager, because the moment you sign up, you'll be assigned an account manager. So ladies and gentlemen, thank you so much for your time. It has been good 2 hours of interaction. I now welcome maybe if there are any other questions or any disturbing questions that might need clarification, please, this is the time to shoot them. And as I wait for your question, so like I said, we have a lot of good programs aligned. Already we begin the webinar series. We did the first one yesterday. Next week on Tuesday, we are going to have another webinar, themed webinar, basically trying to go in depth in terms of equipping you with the knowledge that you need in terms of trading. So I can see there is no any other question. Then make sure, if you have attended this session, make sure to attend the intermediate session, all right? Make sure to attend the intermediate session, which I shared the link. So someone asks, is the bonus losable? So the bonus, the bonus is, how do I say it? So it's basically to help you in terms of increase your margin. So let's say maybe you have deposited $200, and maybe you have a bonus of $400, right? So what it means is that it can be only violated if your account balance goes below what you deposited, right? So maybe you can say it's losable, but in circumstances that it goes below what the account balance that you deposited. Okay, so could you please make a reminder on how to access the recording? So I said the easiest way for you to access the recording without anybody asking you any question is for you, first of all, to be a client in Scope Market. Remember, these webinars are coming courtesy of Scope Markets free of charge. So it's good to give honor where honor is due, all right? Some of these, or not even some, this information that we are sharing here, if you go to look for mentors to teach you, you will part with quite a good number of dollars. But here, through Scope Markets Kenya, you are getting it free of charge. So sign up with Scope Markets Kenya, then you'll be able to access all our webinars. Also, you'll be able to access all the recordings that we'll be doing for those respective webinars. So that's how to access it, Gerard. So thank you so much. I believe there is no any other question. Where are you sharing links for intermediary class? I've shared in the chat. Can you look in the chats? When you look at the chat option, you'll be able to see the links there. Daisy, you'll be able to see the link there, right? In the chats, I believe you have seen them. Okay, I believe you have seen them. So then, having no any other question, all right, having no any other question. So where do you get the chat? You'll see the chat below the Zoom. Below the Zoom, you'll see an option where we have the chat, the Q&A, the chats there below. You'll be able to see that information. So thank you, guys. I believe that was quite informative. We are going to build more on that in our intermediate class. So ensure that you begin signing up right now, right away. And yes, I'm ready here with my WhatsApp, waiting for your screenshot. Let me see the first 10 who will get the one-on-one class. So if your chat is disabled, then just maybe call the numbers here, right? Or you just WhatsApp me. I shared my number, and I'll be able to share the links. So for my number is just WhatsApp. Don't call, it won't go through. Just because you can imagine everyone calling me. So I made it to be a WhatsApp number only, which I always respond on time. All right. So thank you so much. Thank you, Evelyn. Thank you, everyone. And see you in our tomorrow's live market analysis.